To Answering the Critics, Part 2 of RadioActiveTrading.com's rebuff to the critics. Here's what they're saying about radioactive trading. A long call is more efficient than a married put. Now, we already dealt with the idea that it's equivalent in the last video, but they're saying it's more efficient and that you can do everything with a long call that you can do with a married put, but using less capital. Okay, well, let's revisit a very important idea and look at the math that goes under risk management. Okay, the most important part of any trading plan is properly sizing your bet. That's why this exponential curve here is called gambler's ruin. It's also referred to as the martingale. And what it means is that if you have a 25% loss, for example, you don't need a 25% gain to get back to even. You need a 33% gain. A 33% loss would need a 50% gain. And think about it. If you had a 50% loss, you lost half of your capital. You'd need to take what you had left, double it, and that's 100% gain, double it, and then you would have made no progress at all. You're just back to square one. Okay? Now, if you only had a 5% loss, well, looking at the 50% loss needing a 100% gain, you might think that a 5% loss needs a 10% gain to get back to even. But the fact is that the news is better than that. A 5% loss would only need a 5.26% gain. That's because the long tail of this exponential curve is your friend. If you stay far, far to the left, you'll do well. But as we approach the middle and especially the right, we can get hurt, and it's an accelerated exponential rate. What if you're to tell your sweetheart, hey, I made 100% in the market today? Well, the next logical question is, how much did you have invested? If the answer is only $10, well, that's not very impressive, okay? Your commissions will probably cost more than that to get in and out. On the other hand, what if you were to say, I risked and I lost $10,000 on one trade? Well, if you started with $10,000, that's pretty bad. That's 100% of your capital. On the other hand, if you started with $2 million, well, that's a half of 1%. It's the cost of doing business. It's something to expect and not to be too attached to. Okay. Radioactive trading principle number 1 from the blueprint is FIST, or force ideal size trades. You see, we use this as a filter. Here's the 2011 data again on Express Scripts. It's the example that we used in the last video, where a long call is only going to cost you $8.30. On the other hand, a married put is going to cost quite a bit more. Okay? Well, our position sizing is governed by this FIST principle. If you have $10,000 to invest, the married put approach is going to filter this and make it sure that you can only get into one position. Okay? You get 100 shares in one January 2011 $75 put contract, and that's it for this trade. On the other hand, if we were to be trading long calls, and after all, long calls are much more efficient, and they require less capital, well, having $10,000, we could pick up 12 long calls. Let's not forget, though, that we're risking 100% of our capital. When I point out that the married put forces a proper position size, then my critics will say, well, of course, I would only trade a few contracts, or I'd only trade one contract. Well, then what's the use of bringing up this idea of a long call being more efficient? The implication is you're going to either trade more contracts, or you're going to do this one contract but use a lot less capital. And if you're using a lot less capital, as a percent, you're risking a lot more. Trading with too much leverage always leads to ruin. It's just a matter of time. So here's my conclusion to Answering the Critics Part 2. The married put puts limited risk on a stock that you own, not the maybe of a long call. A long call may be efficient in some ways, okay? But I say it's more efficient at losing you money unless you are practicing proper position sizing and putting your money on deposit. When pressured by the facts in my last video, critics often admit, okay, you have to have about 10 times the amount of capital on deposit in an interest-bearing account, and that interest cancels the difference in the cost, because after all, they risk less. Okay, a married put risks less than a long call. With the married put, there's only one account, there's only one commission, and there's less heavy lifting as far as figuring out your position size.